So today we're going to be talking about how the premium tax credit works. So first let's talk a little bit about what the premium tax credit is. Under the Affordable Care Act, sometimes called Obamacare, a new health insurance premium tax credit is available to help people pay for health insurance through the new health insurance marketplaces. And the tax credit is available as soon as you sign up for health insurance and helps pay that monthly health insurance premium. People with household incomes between 100 and 400% of the federal poverty level are eligible for the tax credit. And those numbers on the screen there illustrate what that looks like for a family of four, between $23,550 and just above $94,000. Again, that's for a family of four. And the tax credit is designed so that individuals and families spend no more than a certain percentage of their income on their health insurance, and they use a sliding scale to determine what that looks like, and we'll look at that on the next slide. And the premium tax credit covers the difference between the actual cost of the health insurance plan and how much the family or individual contributes toward their health insurance. So you can see here, sorry for the small numbers and figures here, but wanted to give you a sense of what that sliding scale looks like. So it ranges from between 2% of household income to 9.5% of household income. For a family at 133% of the federal poverty line and below, and again, that looks like just between $23,550 to just above $31,000 for a family of four. They'll contribute no more than 2% of their income toward their annual health insurance premiums. So their maximum monthly contribution will only be between $39 and $52. Now again, the cost of health insurance will obviously be much more than that, but at this income level, the health insurance premium tax credit steps in to cover the remaining cost of that health insurance for that family. And for families between 300 and 400% of the federal poverty line, again, they won't be expected to contribute any more than 9.5% of their income toward their health insurance premiums. And so depending on their income range, those premium costs would be between about $559 a month to $749 a month for a family of four. So when you sign up for health insurance on the health insurance marketplace, you'll enter information on your income, your household size, and also your current insurance status. And the marketplace will then determine whether you're eligible for the premium tax credit, and if you are, how much money you'll receive. And it'll apply that credit to the insurance plan that you ultimately select. The tax credit is paid directly to insurers every month from the government to lower your premium cost, and so you don't have to wait until you file your taxes to get this tax credit. It's a once a month occurrence, and it goes straight to the insurer. So now we're going to look at a couple of examples just to help illustrate how this works in practice. So John, Maria, and their 5-year-old twins, adorable, have a household income of $31,322. They are at 133% of the federal poverty level. So at this income level, they're going to be expected to contribute no more than 2% of that annual income, or just above $626 a year, toward their health insurance premium. The total annual premium cost for the family is $11,000. So their annual premium tax credit is $11,000 minus their 2% contribution of $626.44. So their tax credit equals more than $10,000 a year. Every month, their insurer will be paid $864.47, and John and Maria will be responsible for paying their insurer the remaining $52.20 a month, or 2% of their income. Another example shows Louise, who is single with a household income of $23,000, and this puts her at 200% of the federal poverty level. She'll contribute no more than 6.3% of her annual income, or about $121 a month, toward her health insurance premium. Her total annual premium cost is $5,000, so her annual premium tax credit is just over $3,500. So every month, her insurer will be paid $296 in a premium tax credit directly, and Louise will be responsible for paying the insurer the remaining $121, or 6.3% of her annual income. So an important point on how the premium tax credit works is that premium tax credits are based on your projected annual income. This is how much you think you will make, and your household size for 2014. So it's really important that if there are changes to your income or household size throughout the year, you report those changes to the marketplace so they can adjust the amount of your premium tax credit. At tax time the following year, your projected annual income and your actual income and household size will be reconciled. And so if your family's income goes down or your household size goes up during the year, you could be eligible for an increase in your premium tax credit. But if your income increases or your household size goes down, you should report so the premium tax credit amount can be lowered and you can avoid owing that money back when you file your taxes. You can also and should also tell the marketplace if you begin receiving health insurance through your employer or become eligible for Medicaid or Medicare partway through the year. And this is to avoid, again, paying back a portion of the premium tax credit at tax time. So lastly, to determine whether you qualify for a premium tax credit, and if so, how much assistance you're eligible for, visit healthcare.gov or call 1-800-318-2596 today. And we know that although the rollout of healthcare.gov was rocky, things are running much more smoothly now. So sign up as soon as possible so that your coverage can begin as soon as possible.